You wake up Friday morning, check the news, your bank just failed overnight. You rush to the ATM to withdraw cash, but the screen says transaction declined. You drive to the branch, but there's already a line of 300 people wrapping around the block. Everyone's panicking, trying to get their money out. By noon, the bank closes its doors. By Monday, the government announces your deposits are frozen indefinitely. You have $60,000 in that account. You can't pay your mortgage. You can't buy groceries. You can't access your own money. And suddenly you realize the money was never really there in the first place. This exact scenario happened in Cyprus in 2013, Greece in 2015, and came dangerously close in America in 2023 when Silicon Valley Bank collapsed, the fourth largest bank failure in U.S. history. Within 48 hours, depositors tried to withdraw $42 billion. The bank didn't have it. Regulators seized control. If the government hadn't stepped in, every depositor would have lost everything over the FDIC limit of $250,000 per account. 3 more banks failed within weeks. The contagion almost spread to the entire system. We were 1 weekend away from nationwide bank runs. Most Americans have no idea how close we came to complete financial collapse. Leave a comment below telling us where you're from and whether you trust your bank with your savings. Do you keep emergency cash at home? Also hit that subscribe button, because what I'm about to show you will change how you think about banks forever. Let me explain exactly why your deposits aren't safe and what happens when the system breaks. Banks operate on fractional reserve banking. This means they only keep about 10% of deposits as actual cash. The other 90% is loaned out to borrowers. This works fine under normal conditions because not everyone withdraws their money simultaneously, but during a crisis, when fear spreads, everyone rushes to withdraw at once. The bank literally doesn't have the cash. In Cyprus 2013, the bank had deposits of 30 billion euros, but only 3 billion in actual reserves. When depositors demanded their money, the math was impossible. The government froze accounts and took 47.5% of deposits over 100,000 euros to recapitalize the bank. People who had saved their whole lives lost half their money overnight with no warning. The FDIC insures deposits up to $250,000 per account. Sounds safe, right? But here's the problem: the FDIC insurance fund has only $128 billion to cover $10.5 trillion in insured deposits. That's enough to cover 1.2% of insured deposits. If multiple large banks fail simultaneously, the FDIC doesn't have anywhere near enough money. They'd have to borrow from the Treasury or print money, massively inflating currency value. Either way you lose, you might get your dollars back, but those dollars buy 50% less. You're still destroyed just through inflation instead of direct loss. During the 2008 crisis, the FDIC insurance fund was nearly depleted. They had to borrow from the Treasury and dramatically increase fees on surviving banks. If 3 or 4 major banks had failed instead of just Washington Mutual and IndyMac, the insurance fund would have been completely exhausted. The government would have faced a choice: let millions of depositors lose everything or print trillions of dollars and cause massive inflation. They chose the latter with TARP and quantitative easing. You kept your deposits, but your purchasing power was destroyed over the following decade. Capital controls are the government's favorite tool during banking crises. In Greece 2015, the government limited ATM withdrawals to 60 euros per day. You couldn't access your own money. Businesses couldn't pay suppliers. The economy ground to a halt. People bartered and used informal cash networks. Elderly pensioners waited in lines for hours just to withdraw their tiny daily limit. This wasn't a third world country. This was a European Union member in the 21st century. Capital controls trapped Greeks in their own country because you can't travel without access to money. Your bank account becomes a prison. Bail-ins are the newest nightmare for depositors. Instead of taxpayers bailing out failed banks through government spending, the bank takes depositor money to recapitalize itself. Cyprus pioneered this in 2013. The EU made it official policy in 2014. If your bank fails, they can legally seize your deposits over the insured limit to save the bank. You become an involuntary investor in a failing institution. Your savings evaporate to pay for banker mistakes. This isn't theoretical. It's current policy in most developed countries. Your deposits are no longer truly yours. They're unsecured loans to the bank that can be confiscated. The speed of modern bank runs makes everything worse. In the Great Depression, you had to physically stand in line to withdraw cash. Bank runs took days or weeks to develop. Now with online banking, $40 billion can be withdrawn in 48 hours. With mouse clicks, Silicon Valley Bank collapsed faster than any bank in history. The digital age makes the financial system incredibly fragile. A viral social media post can trigger a bank run in hours. Once panic starts, it's almost impossible to stop. The first people out get their money, the last people lose everything. If this video revealed how vulnerable your bank deposits really are, leave a comment below telling us where you're from and what you think about fractional reserve banking. Do you feel safe keeping money in banks, or are you looking for alternatives? Share this with everyone who thinks their money is completely safe, and hit subscribe so you see the next financial warning before it's too late. Because the next banking crisis isn't a question of if, but when.